Good afternoon, everybody. I'm delighted to introduce the 2021 James Fisher Capital Markets event. I'm Angus Coburn, and I've been the chairman of James Fisher since our AGM in May. I've met several of you on this call in my still new capacity, and look forward to meeting many more of you in the months to come. We'd hoped that we'd be able to hold this event in person, but unfortunately, recent events have changed our plans. We hope to be able to arrange a time later in the year when you have a chance to meet some of the wider management team and visit one of our locations. As I've begun to get around different parts of the James Fisher business, I've been struck by the dedication and pride that the team exhibit in the different businesses. It's a fascinating company with some unique capabilities, and I look forward to getting to know it better over the coming months and years. In the few short weeks since I joined the team, I've been very encouraged by what I've seen. In Owen, Duncan, and the senior team, we have a great mix of experience and fresh thinking. And under Owen's strong leadership, we have the opportunity to reset the business and position ourselves for the future. In the RNS this morning, you will have seen the brief trading update and the outline of the strategy that you're about to hear. In the next 2.5 hours, we will put some flesh on these bones. We have two halves to this event. At the end of the first hour, we'll have 15 minutes for Q&A before a short break. And then after the wrap-up, we will have a second Q&A session. During the presentations, please feel free to ask questions via the text box on your screen, which we will answer during the Q&A sessions. Please feel free also to put your hand up if you would like to ask your question live to the team during the Q&A session. Otherwise, we will curate the submitted questions and answer them in a logical sequence. Any questions that remain unanswered due to time constraint will be addressed on our website for your future reference. We're looking to close by 4:30. Apparently, there's some football match happening at 5. So this will give everyone time to prepare for the mental torture of the inevitable penalty shootout. Let me introduce you to the team here today. Owen O'Leonard has been our Chief Executive since October 2019. He will present our group strategy and then sum up at the end. Following Owen's overview, we have two deep dives. First, with Elizabeth Skinner, MD of Fender Care, and second, Richard Deller, MD of JFD. Once Richard completes his presentation, we will have the first Q&A session before a 5-minute break. Giovanni Corbetta will kick off the second half with marine contracting, followed by Robin Stopford on new business opportunities. Duncan Kennedy, who joined James Fisher on the same day as me, will then share with you his approach to capital allocation before Owen wraps the afternoon up, leading into the final Q&A session. With that, I'll hand over to Owen. Thank you.
Thank you, Angus. Good afternoon, everyone, and again, welcome to the James Fisher Capital Markets Event 2021. I'm Owen O'Leonard, Chief Executive, and I'm delighted you could all join us today for what I hope will be a useful and informative update to our strategic direction of travel here at James Fisher. I'm going to take you through an introduction to our new strategy to deliver sustainable, profitable growth and improved returns for all our stakeholders. For those of you familiar with James Fisher, you may recall that we have historically reported on 4 divisions: marine support, specialist technical, offshore oil and tank ships, as shown here. In this portfolio, we have a number of world-leading businesses spanning the marine, energy and defense markets. And here's a selection of some of the quite remarkable things we do in those businesses. Fender Care is the #1 global leader in ship-to-ship services for customers transferring crude oil and increasingly LNG from one ocean-going tanker to another, often in inclement weather under severe time constraints. Our mooring masters are trusted as the safest, most efficient, and most environmentally trustworthy partners by the great and the good in the industry. Elizabeth Skinner, Managing Director of our Fender Care division, will share more with you about this wonderful business a little later. When a naval submarine gets into difficulties, as sometimes happens tragically, the first name on speed dial is James Fisher. When called upon, our team kicks into action, deploys a submarine rescue vessel like the one shown here to the bottom of the ocean to locate the stricken submarine and to bring home the sailors. We are the number one, indeed the only provider of fully untethered submarine rescue vessels and services to NATO, India, Korea, Australia, Singapore, and a range of other leading naval customers. Richard Dellar, Managing Director of JFD, will give you an update on some of the frankly awe-inspiring products and services in our defense and diving operating company. With over 200 programs completed supporting the installation of fully half of the global offshore wind capacity, James Fisher is the outright number one in the engineering, installation, commissioning and monitoring of arguably the most critical of all assets in an offshore wind farm, the high voltage cables, switchgear and substations. Giovanni Corbetta will share more with us on the hugely exciting prospects for our business in renewables and subsea contracting. But before any offshore wind farm can be built, the seabed must be cleared of obstructions. These obstructions are sometimes benign, boulders, for example, but often the obstructions are explosive, unexploded ordnance to be precise. And these have been a feature of just about every site where offshore wind farms have been constructed. James Fisher has earned a reputation as the most trusted service provider to remove unexploded ordnance, and we've removed more than any of our competitors. Harkening back to our origins 174 years ago, when the Fisher family plied their trade across the coasts of these islands, our tankships division, with a fleet of 14 purpose-built tankers, is the number one in the delivery of petrol, diesel, and heating fuels to the ports of Britain and Ireland. And James Fisher Nuclear were the pioneers, the very first to decommission a commercial nuclear reactor core in the UK, the Magnox heavy water reactor in Winfrith in Dorset. We're recognized the world over for our expertise in engineering, manufacturing, and testing. And we make the equipment used to segment, to cut up and to package the cores of these nuclear reactors. It is on the back of these commanding positions in these leading companies and other ones that James Fisher has created a track record of generating strong, reliable, year-on-year revenue growth over the last decade. Certainly, 2020 was different, and we'll come to that in a moment. But even as we invested capital to grow our revenues, margins have remained stubbornly flat as we've struggled to create operating leverage, and return on capital employed has been in decline for several years. At James Fisher, we place great store in our decentralized operating model and our entrepreneurial and autonomous operating companies, and I would say justifiably so. Having personally operated through this model in a number of great companies, I am a believer that this model can create and sustain great results. However, it is equally my belief that such a model works optimally only when everyone is aligned to the broader mission, the autonomy is underpinned by process excellence, and the entrepreneurship is balanced with appropriate and effective governance. With this in mind, and spurred on by flat margins and declining ROCE, we're taking action to return James Fisher to the path of sustainable, profitable growth, margin expansion, and improving ROCE. My presentation will explain how we're going about doing this, but before we launch into our new strategy, I'd like to take a moment to reflect on the last 18 months. Many have tried to describe 2020, but at least we can agree it was a year like no other, and there were challenges galore. Like many companies, COVID-19 had a major impact on colleagues and their families and trading in this company. Even before that, we were hit by a ransomware attack, the first in our history, which required us to get on a steep learning curve and to make the investments that are keeping us safe and secure today. We also struggled under the burden of unproductive assets like the dive support vessels we purchased in 2019 and the failed acquisition in Saudi Arabia, and these badly impaired our results. And the collapse in demand in subsea services, and particularly oil and gas, but also renewables, highlighted existing fault lines in our largest division, marine support. And in the face of all of those challenges, we had to execute a reduction in workforce of some 20%. unprecedented in our history. On the more positive side, we had quite a lot of things go well for us as well. The "we're all in this together" response of colleagues was truly uplifting. And we did have some standout performance among our businesses. For example, record ship-to-ship revenues in the first half on the back of oil market volatility. We completed the Shanghai Salvage 500 meters saturation diving spread despite multiple lockdowns. And more recently, we've seen an upsurge in global contract wins for both oil and gas decommissioning and offshore wind construction projects. But above all, we were and we remain very proud of the resilience shown by all our colleagues at this most challenging of times. And while we were managing our way through the unprecedented challenges of COVID and all that came with it, we have also been actively preparing for the future. We've created and deployed a 3-phase roadmap to address our strategic and operational challenges. The first phase is reset, which started last year and will run through the end of this year. We've reset to what we would call a back-to-basics approach to managing our business. We're refocusing on select market niches. We've actively re-engaged all our stakeholders, and we've deployed a fix or exit policy regarding underperforming businesses and assets. We've already completed 2 divestments, and more are likely to follow. The second phase is reinforce, which will span the next couple of years. We're reinforcing continuous improvement principles. We're defining and deploying KPIs across all stakeholders. We will continue to actively manage our portfolio, and we're investing in technology for future growth, including to fuel the energy transition. The third phase is realize, which will run through 2025. It is during this phase that we will realize our midterm environmental and financial targets. We will deliver top quartile industry sustainable growth, and we will accelerate growth of new business in energy transition. Taking cues from our 3Rs roadmap, our strategy to deliver sustainable, profitable growth is built on a framework of 4 parts. First, we've embarked on a journey to become purpose-led and values-driven. Second, we're placing our stakeholders at the heart of our company, thereby creating what we regard as an intrinsically sustainable business. Third, we're investing to reinforce our key internal processes. This is vital to driving sustainable growth and margin expansion. And fourth, we're refocusing on the niche segments of our chosen markets, where James Fisher offers distinctive, differentiated, defensible value, and where we can accelerate investments in support of a responsible energy transition. I'm going to take you through each of these 4 parts of our strategic framework in the next few slides. First up, our purpose and valued behaviors. Since we started out 174 years ago, James Fisher has always been a pioneer in marine, in energy, and perhaps a lesser known fact, in defense. We've eschewed the easy tasks. We always look to take on the hard jobs, providing solutions for our customers that others couldn't or wouldn't, often in hazardous locations, and always with a weather eye to sustaining both the business and the interests of our stakeholders. This is the way in James Fisher, and this is what we have sought to capture in our purpose statement: to align, to engage, and to bind together the disparate parts of our company, which have become somewhat fragmented as we've added so many cultures and organizations over the years. Equally, we've laid down our valued behaviors. Led by our purpose, we are driven by these values. We are as motivated by how we achieve our purpose as by what we do to achieve it. Second part of our strategic framework is a commitment to placing our stakeholders at the heart of our strategy. We identify with 5 core stakeholder groups here in James Fisher: employees, customers and suppliers, the local communities in which we operate, the environment, and our shareholders. And our conviction is that by releasing the latent potential of our pioneering employees and enhancing our position as a trusted partner for our customers and suppliers, and becoming a truly outstanding citizen of our communities whilst investing in technologies and capabilities to fuel a responsible energy transition, we will deliver better and more sustainable returns for our stakeholders. Our sustainability plans are not being developed separate from our group strategy. They are being developed as an integral part of the group strategy. Based on a company-wide materiality matrix, we're developing consistent measurement of baseline performance and setting non-financial KPIs and targets, which will help direct engagement with stakeholders across the E, S, and G landscape. On the environment, we're increasing the coordination of activities across the group to have a meaningful impact on energy transition as well as reducing day-to-day impact. On our social obligations, we are focused on improving alignment and engagement of our employees, as well as better coordinating the many activities of our employees in our local communities to ensure we have an even more material, positive impact. And last, we're improving all aspects of governance to strengthen the foundations for future profitable growth. To improve governance, we've already taken a number of key actions. First, with the objective of creating clearer lines of sight from our lean group center to our various operating companies, we've split our largest division, Marine Support, into 3 subdivisions and promoted our top OpCo MDs to drive synergies in what are now our 6 divisions, as shown here. Second, in addition to this group-level reorganization, we've also been actively reshaping the portfolio by merging several businesses, large and small, thereby reducing the number of OpCos and eliminating unnecessary costs. But an organization is only as good as the people in it. And our people are our greatest assets only when they are fully engaged and aligned to our purpose and our valued behaviors. To cultivate this engagement, we've created a broad-based employee strategy, bringing into the 21st century James Fisher's approach to engagement, diversity and inclusion, well-being, talent management, and organization development. Additionally, we've been proactively refreshing our leadership ranks with some phenomenal talent who bring with them experience of working in great companies in the markets where we see further opportunity for growth. And to anyone who might regard these actions as normal parts of the day job, well, we agree. This is self-help 101. But this work is having a far greater impact in James Fisher as it hasn't been done in some time. When it comes to the E in ESG, James Fisher has successfully navigated energy transition several times in our history, and we aim to do so again now. We have for some years been reducing our reliance on carbon and funding environmentally sustainable growth by actively reinvesting cash from our legacy positions in oil and gas, where we are trusted, and we'd like to think trustworthy custodians, into both established and growing positions in the renewable energy and environmental remediation value chains. Gio will discuss how we're making a tangible difference in offshore wind. Elizabeth will touch on the exciting prospects of leveraging our leading position in crude oil ship-to-ship transfers into the rapidly growing LNG STS market. And Robin will update us on some of the promising newer investments we're making in environmental remediation. For example, in specialized IP-protected technology to safely and efficiently decommission oil and gas structures, in big bubble curtains that protect the subsea environment during construction programs, in flare gas capture and reuse technology, which will radically clean the air we breathe, and in the efficient oxygenation of fish farms, which reduces the stress put on the environment from food production, even as there is ever greater demand. And so, what's the so what of all of this? Where does this lead James Fisher? Well, as we continue to put strong legacy cash flows to work in growing our renewable energy and environmental remediation businesses, we envisage that these investments will transform our company and the value we add to all our stakeholders. Duncan will cover more on this as part of his presentation on capital allocation. The third part of our strategic framework is a commitment to process excellence. We've identified the core processes which will underpin future profitable growth for our group. By actively managing our portfolio, by reducing leverage and deploying a balanced capital allocation process, by improving and scaling our commercial and contracting capabilities, and by striving for a world-class safety, risk, and project management culture, we will deliver sustainable, profitable revenue growth, expand margins, and improve the returns on the capital that we employ. Our approach to portfolio management is a set of clear tests to manage our current and future portfolio. The first test is strategic fit. Does a business fit with our purpose, and does it operate in our chosen markets? Then on attractiveness, there are 3 parts to the test. Is the market segment growing and of an attractive size? Do we have a defensible competitive advantage in this segment? And can we reliably and sustainably generate north of 10% operating profit and more than 15% return on capital employed? Based on a rigorous analysis of our current portfolio and facing up to some home truths, as well as a determination to fix or exit underperforming assets and businesses and a commitment to accelerate investments which will underpin future growth, our tests are already guiding portfolio actions. Those businesses in the bottom left quadrant have probably failed one or more of the tests. Their mission is to chart a course to be fixed, or they will be sold. We already have sold 2 businesses, and more underperforming businesses and assets are likely to follow. Businesses in the top left quadrant passed most of the tests but may not be operating optimally. They will receive special attention to move them to the right of the chart. Those in the bottom right likely have less opportunity for growth but are reliable cash generators. Their cash will be deployed elsewhere for growth and to fuel the energy transition. And those businesses in the top right quadrant, about 1/3 of our current revenues, these will get more investment to grow them to their full potential. And for all the businesses we retain in our portfolio and for those we will acquire in the future, process excellence reinforces revenue growth and margin expansion. There are already pockets of world-class processes in James Fisher. Our great opportunity is to leverage these best practices across the group. We're determined to embed the principles of lean and continuous improvement in our businesses because this is the way to guarantee the consistent and efficient operational delivery which underpins sustainable profitable growth, margin expansion, and a return on investments. The 4th part of our strategic framework is to refocus on our chosen markets. James Fisher sets itself apart from competitors when we focus on solving the difficult problems in specialist niche segments. We have a strong track record of success across the 3 global mega markets of marine, energy, and defense, and our focus is on providing differentiated solutions in high-margin niches, often where these markets intersect. That differentiation is created through innovation and technology. And while the global nature of these markets provides expansion opportunities, additional growth opportunities are being created in adjacent spaces within the chosen markets. And that's a big part of the James Fisher story. We create differentiated solutions in niche segments through investments in innovation and technology, and then we market our products and services in one or more of our other core markets at the same time as deploying these solutions globally. And as this chart shows, we hold leading positions across several geographies in a number of our businesses, like Fendercare and JFD and Marine Contracting that we will showcase today. And we anticipate continued growth in these markets. Also, we expect further opportunities for us to invest in bringing our differentiated products and services to customers in arguably less developed but faster growing markets. And so, bringing it back to where we are headed. We're following the 3 R's roadmap, and we will address both strategic and operational challenges by resetting to a back-to-basics approach to managing our business, by reinforcing the foundations in which sustainable, profitable growth will be built, and by realizing our medium-term environmental and financial targets. Our strategy for sustainable, profitable growth is already underway. We've embarked on our purpose-led and values-driven journey, bringing stakeholders into the heart of the strategy, and we've been actively upgrading our leadership talent. We're driving better governance through an effective divisional structure, deploying lean principles to deliver operational excellence and underpin growth and margin expansion, and embedding our new capital allocation process and risk management culture. We're refocusing the portfolio on niche segments with a fix or exit policy for underperforming assets and businesses, and we're accelerating investments in a responsible energy transition. And with that, I'd like to hand over to Elizabeth Skinner, who will share with you an update on Fendercare and how this division is an indispensable pillar of our sustainable, profitable growth strategy. Liz, over to you.
Yes, good morning again, Captain. This is the Fendercare Mooring Master speaking.
Thank you, Owen. Hi, I'm Elizabeth Skinner, the Managing Director of Fendercare. I joined in 1998, 22 years ago. The offshore oil ship-to-ship transfer industry during this period was very different, not understood. Ship-to-ship being used as a last resort option by our clients, mainly due to port congestion. When I joined, we conducted 50 operations in only 3 locations. I've been fortunate to have gained experience through very strong organic growth and delivering operations on a 24/7, 365 days a year to the highest standards, establishing new locations in the areas such as India, Nigeria, and Brazil, as well as closing and redirecting our equipment in new locations to ensuring our returns on assets remain high. We've expanded our footprint in over 50 locations across the globe, conducting over 3,000 operations in a single year. And that's why we have the world-leading position in ship-to-ship. Fendercare have transformed the industry, changing this last resort service into a recognized, high value-added commercial solution to our clients and providing increased trading opportunities and transport efficiencies. Fendercare is the world leader in ship-to-ship transfer services, supplying critical safety and well-being products and marine products. Revenues of 115 million, employees of 176, and over 50 locations. The business is strategically placed across the globe to support the energy industry, a division of 3 products and service companies. The biggest section, a ship-to-ship service, provides the Fendercare brand, a marine products business by the Fendercare brand, and a safety and well-being products business via our Martech brand. The STS division is a leading provider in the industry. We have extensive experience within our team, all who dedicate themselves to this niche industry, therefore becoming that trusted go-to company by our clients, such as oil and gas majors, the likes of Shell, BP, Glencore. We are transferring cargoes such as crude, fuel, and refined products like gas oil and jet fuel. LPG is a regular part of our business for over 20 years, and now that technology is overcome, we are now able to transfer LNG at sea. And moving on to our second business, a marine product supply business, supplying marine equipment across the globe. When our clients think of Fenders or Yokohama, they think of Fendercare. We have a reputation to provide our clients not just our high-end products, but also solutions to their offshore challenges. And thirdly, our Martech business. The Martech acquisition and subsequent inclusion within the Fendercare division brings further expansion to our products portfolio and further opportunity to leverage on our distribution network. A business supplying products to assist the safety and well-being of our client employees on and offshore, supplying gas detection, water quality testing, and defibrillators. Equipment predominantly centered around the support of the well-being of our employees. Fendercare is globally number 1. We have an exemplary operational safety record, and that's why our clients are confident with our ability to deliver in some challenging locations, as you will see from the dots on the map. Our global scale is a key differentiator. No other provider comes close. We understand that time is a critical factor to our clients, and having equipment ready to mobilize has been and will be key as the oil market wakes up after the pandemic. We have significant expertise conducting STS services for over 26 years, conducting on average 2,500 operations per year, 600 million barrels per year transferred, and since 1995, we have transferred over 8 billion barrels. The market looks to Fendercare for technical leadership and guidance. We have provided industry our expertise, driving safety standards to the highest possible level. We continue to increase the distance between us and our competition, as well as increasing the barriers to entry for new organizations. And we are that go-to company for niche marine products, clients recognizing our ability to deliver on time and at short notice in any location in the world. As part of the strategic review, as mentioned by Owen, we have applied all 3 tests across our Fendercare business. Market size and growth. The oil and gas market has been affected by COVID. We know the oil recovery is on its way, and we will defend and grow this market. We will add new STS locations and use our footprint across the globe to expand our marine safety and well-being products and grow our business, supporting our clients on their journey to trade more LNG. And competitive strength. We will continue to grow and defend a market share of over 40%, and will continue to drive ahead, remain close to our clients and deliver to the highest standards through operational excellence and sustained profitability. Our business model remains flexible with low fixed costs, allowing us to secure strong margins and return, and allowing us to quickly adapt to the changing oil and gas flows. So Fendercare's focus areas. Fendercare has 3 major things that will be driving major growth: geographical footprint in new STS bases and expanding products, LNG, and digital innovation. So firstly, geographical footprint. New locations is where we see the growth. The yellow dots represents just a few of those we are looking at. We have over 30 possible areas we're investigating for potential for STS services, such as Mexico, Bangladesh, Canada, and Australia. Most of our opportunities are client-led. However, locations such as Bangladesh are where we see the first mover opportunities. Recognizing that Bangladesh government are encouraging the use of LPG for cooking purposes and to use as an auto gas for vehicles, while the country does not have the port infrastructure, we believe STS can provide a flexible solution to assist the import of LPG into the country. And both Fendercare and Martech products you will use our network of locations to expand the client reach. LNG. Our ambition is to become the leading provider of LNG STS and building this service across our client footprint and into new locations, exactly like we've done in oil. Fendercare has been predominantly a port-to-port business, where oil was 15 years ago. Fendercare has been supporting the transfer of STS LNG for over 5 years, monitoring it closely. When will LNG become the next viable option in the supply chain? We believe the time is right. We see a sharp increase in global LNG demand in the coming years, and we will work closely with those same trusted oil clients as they pick up speed to get out of the oil trade and look to trade further into the LNG market. We will assist them to find offshore solutions. With the lack of LNG port infrastructure, STS will have to be one of those considerations for efficiently moving LNG around the world. Fendercare have invested in its own transfer equipment this year with a view to capitalizing on this emerging market opportunities, supporting the growing LNG trading opportunities. And digital innovation. Fendercare recognizes the importance around operational efficiencies and how critical time is for our clients. With vessel day rates at $70,000 per day and cargoes over $100 million at a time. There is a need to bring more real-time information into the STS industry, provide our clients faster, quicker information, having more vital, critical information at hand, and allowing them to make the right trading decisions. Information, we believe, will be critical to add further value to their trades. We will increase AI around pre-operational checks and risk mitigations to increase the safety, allowing our clients to be able to instantly book an operation with us, negating the need for email exchange and locking out our competition. Now they can come to our portal and in future our app, and we will become the Uber of the STS world. And secondly, Fendercare has the largest data set on STS. We've been approached by one of the largest multimedia companies to gain our data. With our STS volumes, geographical spread, and more importantly, our deep knowledge on when and why clients conduct STS, we will use AI to assist us in the forecasting the needs of our clients, allowing us again to be streets ahead of our competition. And thirdly, continuing to advance our e-commerce platforms to ensure we remain the leading edge on the marine procurement practices and becoming the Amazon of the marine world. So in summary, the Fendercare takeaways. Fendercare is the global leader in providing ship-to-ship services and marine safety products. We will have growth through geographical expansion and supporting transition into cleaner fuels. And we'll continue to have an exemplary safety record, use our scale and expertise in driving customer satisfaction, and continue to be that strong and reliable cash generator to fund growth for the James Fisher Group. Thank you. I'll hand you over to Richard Deller from JFD.
Thank you, Elizabeth. Welcome to JFD. It's worth pointing out, first of all, that we have no offensive capabilities whatsoever. The statement on the left is what we do and why we get up in the morning. We protect life where customers operate in high-performance undersea environments. A small overview. We typically turn over around 100 million a year. We have 550 employees, and we have 8 major locations. We go to market with the brands you see in the bottom box. The picture on the right is really fresh and interesting. It's the first sea test for delivery of a brand new sub-rescue system to a Chinese shipyard. It was only taken last week near our factory in Glasgow, and it's due for delivery at the back end of this year. So let me tell you how JFD goes to market. First of all, we offer a full capability, a through-life option for the customer, where we supply the product, we maintain it, we train the crew to operate the vehicle, and then we support it over the life of its program, which could be anything up to 25 to 30 years. A typical customer here would be recently the Indian Navy and the Royal Australian Navy. Secondly, we offer a supply of standard or bespoke configurations across a very broad range of life support equipment. Typical customers here might be the Royal Navy. Thirdly, is a service offering. This is contracted separately, and it's in the support and maintenance of either our own or third-party products. The NATO sub-rescue service is a good example, and we do this on behalf of the UK, France, and Norway. Finally, is our specialist technical. This is supplied on an ad hoc basis, specialist technical or training needs, with the National Hyperbaric Centre based in Aberdeen being one of them. This is where we'll test equipment or provide remedial healthcare services for personnel with the bends. Our biggest customer for that operation is the National Health Service. Now I'm going to talk about the market, our competitive position, and our performance. The overall annual market fluctuates somewhat. However, we see an average of £500 million per year. The danger of working subsea environments is ever present, as we've seen recently with the sad loss of the KRI Nanggala in Indonesia. We've seen continued growth in global maritime defence spending with a CAGR of around 4% over the last 4 years. From a competitive strength perspective, we are the #1 company globally in submarine rescue. We're the #1 in commercial diving life support systems and equipment, and equal #1 in diving rebreather systems. This is all underpinned by our unparalleled knowledge and expertise in life under pressure. From a performance perspective, the criticality of the products to the environment and the customer demands drives niche products and continuing strong margins and returns. We spent a lot of time and effort on the processes and infrastructure that can assess programs and opportunities and then execute on them effectively. We're looking to complete the integration of a number of historic acquisitions. There's a lot of detail on this slide, but this underpins everything around the operational strategy of JFD. The foundations are already in place. There's been a number of site consolidations made, and we're completing them through this year. From the top down to the bottom, this is around managing and developing global processes across the 8 operating sites. It's around understanding the competence and the capabilities of our workforce, our processes, and our systems. It's about understanding the analytics and the usability of our business systems and tools. And finally, it's supporting our ESG strategy around supporting and developing local STEM programs with colleges and local schools. So this is where JFD fits into the James Fisher Group. We have 5 broad capabilities that I'm now going to talk about. Firstly, our commercial diving products and systems. The picture on the left is a diver using one of our rebreathers. Our ambition is to remain the market leader and that #1 position. We'll achieve this by utilising our own capabilities to drive value upgrades in safety and customer operational efficiency. This is a defence life support rebreather. Here, I mentioned earlier, we're equal number one. This is around maintaining our current position and growing it. We'll achieve this by ongoing development of the next gen products and technologies to secure high margin contracts across all naval diving operations internationally. Our submarine escape and rescue business is the global number one. So this is a maintain and grow strategy. Here, our ambition is to enter the US market while maintaining our international leadership everywhere else. Our actions are to invest or partner in the US whilst continuing the development of new systems and subsystems and secure incremental international rescue services. For your information, the size of the submarine you see in the picture is around the size of a single decker bus. And right now we have 3 of these in build simultaneously in our factory in Glasgow. This is a grow strategy. This is around submarine platform solutions. This is around translating our leadership in this area into major global submarine programs, initially combining life support and special operations capabilities. The action for this is we've recently won our first major contract win as a through-life prime contractor direct to the end customer. We'll look to build on this to secure further long-term contracts to expand our market penetration. Mobility solutions, this is a new area. This is a grow strategy for us. And our ambition here is to become the market leader in maritime mobility solutions. In order to achieve this, we are supporting multiple navies in adopting this capability, building on our first contract win of greater than £30 million. What you see on the left is a squadron of hybrid vehicles. These vehicles have the ability to travel over water up to 30 knots and then seamlessly transition into subsurface vehicles, i.e. mini submarines. And we have 3 systems under trial with navies around the world right now. In summary, this is an interesting business. It's a portfolio of world-leading capabilities, but they're all bound together by critical life support capabilities. The margins are always north of 10%, and they're driven by our niche high-performance sectors and the customers we work with. A more integrated model will create future profitable growth, and that's really focusing around the integration of the prior acquisitions or completion of the integration on the prior acquisitions, and then making the most out of the technology that comes from those successful integrations. And lastly, there is still room for geographic expansion. High on my list is North America, which we will address through either partnerships or acquisition. Thank you. Now back to Owen for the first round of questions and answers.
Good afternoon, everybody. Now we're live in the room, and we're going to do our first Q&A session. The first few questions we're going to take are the ones that have been submitted during the presentation. So the first one is Gareth Hayward, and I will read it out. I'm intrigued to know what an irresponsible energy transition entails or looks like. Hopefully that's not what you're going to get from us, Owen. Over to you, Owen.
Angus, thank you. And Gareth, thanks for this intriguing question. Our view is that we are trusted and trustworthy custodians of our positions in the legacy businesses dealing with oil and gas in particular. An irresponsible approach to that, both from, I think, a societal point of view as well as for the company, would be for us to say, well, we're out of here and we sell our positions arguably to people who are less trusted or less trustworthy. That's not what we intend to do. What we intend to do is to manage this transition by investing in new energies like offshore wind, whilst at the same time continuing to be custodians of oil and gas from an efficiency, from an environmental point of view, and from a safety point of view.
Thank you, Owen. Second question from Andrew Douglas. And I'm going to ask you both these consecutively. And Duncan, I'm going to ask you to take the other question. The end market evolution you outline, Owen, as part of the energy transition, Does that take into account acquisitions, or is it just an organic evolution in disposals? And then Duncan, for you to think about, of the 15% of revenue you're planning to exit, what percentage of group EBITDA is that? Owen first.
Very good, Angus. And Andy, thanks very much for the question. This is the slide where we point to the evolution of our portfolio, where we invest in offshore wind and renewables, as well as in environmental remediation technologies and businesses. And we would anticipate, as those businesses grow, the relative importance of oil and gas in our portfolio may decline. This will happen because of the organic investments we're currently making and ones we will make in the future as well. But we wouldn't rule out opportunities to bring in new technologies from an M&A point of view, as bolt-on acquisitions have been an abiding part of the James Fisher operating model.
Duncan, second part.
Yeah, hi Andy. Thanks for the question. That bottom left box on that slide, of course, is either reposition or exit. So first up is working with those businesses to see whether we have a route forward to hit our 10% and 15% targets. On the specific of your question, though, it does represent a much smaller percentage of EBITDA than 15%. And I guess, they're in that box because they're not consistently hitting 10% operating margin just yet.
Thank you, Duncan. We want to talk about, first of all, the market in terms of transfers for crude and transfers for gas.
Thank you. So as we know the oil recovery is coming, and certainly we've been in a bit of we see that they've been getting rid of the excess inventories across the globe. When the recovery comes back, we hope that trading picks up, and so that we do see that increase in volumes in crude, as you asked. So we do see that increase coming for the next, in the future, and we see that the oil recovery is going to come down to 2022. We should be back to pre-pandemic. And then LNG, we've had some great opportunities from our clients, and they are working on some interesting projects. And so we see that growth coming in LNG. We've got our first project coming up, and once that's concluded, we should have a better vision of what that looks like for the future.
And in terms of, are there other products suitable for what you're working on, or is it largely going to be the crude and the LNG? It's largely going to be crude and LNG market we're looking at. We are listening to the market, and everyone's talking about hydrogen, and that's going to follow on to LNG. So we are keeping close to that, and that is on our program to have a look at what does that mean for us in the future. And just the final piece, my understanding of the question was, as you expand geographically, could you, as Fendercare expands, create opportunities for other parts of the group? Are there synergies that you can bring to other divisions? Yes, certainly. I think that's where Fendercare's strength is. If you look at our global footprint, we certainly are in most of those locations around the world that are critical in the oil and gas and even the renewables market. So we'll be working across the James Fisher Group to provide those synergies and leverage off our footprint. Liz, you're going to win the popularity stakes by the look of it, because question 4 is also one on your business in terms of the competitive landscape and how that's evolving. Mm-hmm. We don't see any, certainly for the landscape, we haven't seen any major competitors enter the market over the last 3 or 5 years. And we do, it certainly was during the pandemic. We certainly were able, because of our global spread, deliver to our customers. We were fortunate to have that spread where our competitors don't have that reach. And so we were able to deliver, which is great. A question we were talking about the other week, are you going to stay ahead? What are you doing to stay ahead and stop the risk of someone catching up? And then I promise I'm going to leave you alone. Well, I think if you saw in the presentation, the digital innovation that we have done so far, our customers have given us some excellent feedback, and they are really liking all the ideas that we're going to bring to them, and they believe this is going to make their lives and add a lot of value to them. So the feedback's been great. So I'm confident we're going to stay ahead, and certainly. As everyone knows, safety is on the top of all of our customers' agendas, and they are pushing
us to push the standards. So, and we are that exemplary company. So, yeah, I'm confident we're going to stay ahead.
Very good, thank you. Moving to defence, and Andrew Douglas asking, on JFD, how easy is it to get into the US market, and why are we not there? And has there been a change in the competitive landscape in the US? Maybe Owen.
I'll pick it up, and Richard may want to add to this. I don't think we've been as focused as we might have been on building out a position of strength in the US. It is the largest defence market in the world. It's where I think a lot of companies such as ours would want to play. You've got to partner with an incumbent or perhaps buy an incumbent to really gain access to the market. That certainly will be something we're working on. We already have irons in the fire in terms of partnership, and we're going to have a closer look at potential acquisitions over time as well.
Thank you. Question 6 from Darren is about floating wind farms. I wonder, Giovanni, we come back to that at the end, and we'll open up Daniel with that question. Sorry, Darren, with that question at the end once we've heard a little bit about what we're doing on renewables. Tom Rands has asked a question, and unfortunately, despite my promise, there's a couple we're coming back to you, Liz. The LNG opportunity, what actions or investments do you need to make to increase our exposure to this market? And how much of the 200 million of sales relates to LNG at this point?
Okay. So certainly I'll take obviously with the investments, we have made that first investment in LNG equipment. And mainly luckily with the footprint, we've made a lot of that investment. You can't use all the STS locations around the world because you do need the right weather conditions for LNG operations, but we have that footprint. So it is very small investment. It is an investment, as Owen said, in people, training. So it's a low investment for us.
And it's fair to say, at the moment, it's a very small part of your business, LNG. You're on your first project, and
it's a small part of our business at the moment. We have been assisting the LNG market in operations. And we have that first, as I mentioned, operation coming up. We are really keen. We've got to get that done. We've got to make sure that for our client, and then we will be able to assess then what does that future look like. So it is early days for us, and it is a growing market, over the next, years to come.
Thank you. Owen, going to ESG targets. Argos Global is asking, do we have specific ESG targets integrated into our exec compensation policy? And if we don't, can we just explain why not, and perhaps more appropriately, where we're going in the future?
Thanks, Angus. The answer to that is we do have parts of executive compensation related to personal objectives. And those personal objectives over the past while have been aligned with our stakeholder strategies. And as you'll recall, our stakeholder strategies span the E, the S, and the G. So the 20-30% of executive short-term compensation is directly related to the actions that we're taking to put in place and to action the strategies for our 5 stakeholders.
And as we're going forward, we'll look to build on that.
Well, I would anticipate that this will become a necessity beyond simply the personal objectives, that the harder business-related activities would also be compensated relating to how we're performing on environment, on social, and on governance issues. Absolutely.
And we're into the last couple of minutes, so I'll just take another 2 or 3. And why don't we start? And I've got a lot of sympathy with you here, Duncan, given your time in office, but EBITDA margin and 10% group target, what percentage of the group do you think is at 10% already?
Yeah, nice question, and thanks for the sympathy, Angus.
You won't be getting a lot.
So if you look at our 4 divisions, historically we've had 2 very comfortably above the 10% margin, 2 that sit there or thereabouts, and with a bit of work to do I'd say if we look at the total number of businesses we have within our portfolio, we're probably about 2/3 of the way there. Angus.
Thank you. And I think this is one for perhaps Owen, but feel free, Robin, Duncan, to help out. How much revenue is generated from customers who use more than one division of James Fisher? And I know, Owen, that is something that's very, very close to your heart.
Well, I think the topic of finding crossover opportunities from one division to the next is one of the things we put great store in. It is an area that I think historically our managing directors, the leaders of our businesses, have sought out opportunities to work together, but we haven't necessarily helped or orchestrated that from the center. It's an area of interest to us that we would anticipate will yield more value over time, not less. In terms of the actual percentage, I'll have to get back to you on that, Tim.
Thank you, Tim, for that question. And any questions we don't answer, we're going to answer on the website, and clearly we will answer that piece of it. Now, here's a question in two parts. This is back to Argos Global. And the first part, I think we'll enjoy the answer. And the second part, I'm going to enjoy the question because I think it'll be rather challenging. What will the business look like in 10 years, Owen? And in 10 years' time, what will the revenue contribution by division and normalized margins look like?
Well, in 10 years' time, as we've indicated in our presentation, we anticipate that our relative weighting towards oil and gas will diminish as our relative exposure to renewables like offshore wind and environmental remediation businesses will grow. The exact percentages maybe are not what you're after here, but I could anticipate that if we are 50% exposed to oil and gas today, that may decline substantially, perhaps into the 15, 20, 25% of our business. And that indicates that our expectations are that there will be rapid, significant growth in our renewables businesses and our environmental remediation businesses. The second part of the question, Angus?
You've answered it because we're not. You've given an indication of where the business will be in terms of revenue and normalized margins. But I think we've given an indication of where we're looking to get to in the medium term.
Well, absolutely. As Duncan said, and as we've had in the presentation, the starting point for us is to get back to north of 10% operating margins. The number of years it takes us to do that remains to be seen. As quickly as we can is the answer. But then we see opportunity beyond that, and what that ultimate profitability level is for James Fisher. It'll be north of 10, but how far north? We'll do our best to drive it as hard as we can.
And just before we break, there's one raised hand. James Beard.
Thanks, Angus. Afternoon, everyone. It's a quick one on Fendercare again. You've obviously spoken about the sort of competitive environment on the ship-to-ship side, but just wondering about the competitive environment on the product distribution side of the business. How does your market share compare there to other key players, and what, if anything, can you do to go about increasing that market share?
Thanks, James. Yeah, it's certainly a challenge for us. As we know, we have got competitors in the market now. But we do, again, we are partnered with the leading, on the Fender side, we are partnered with the leading brand, the Yokohama. So we still have the market share lead on that. And then we're working hard as part of our strategy, as Owen mentioned, to find new niche products to bring to market. So we've got some exciting new products that we're looking at, and hopefully that can keep our competitive edge.
Thank you very much, Liz. Thank you all for that. Now, can I suggest that we take a 7-minute break, an extra 2 minutes bonus, and we will come back here and we'll start up again at 3:15. Thank you.
Good afternoon. I'm Giovanni Corbetta, Managing Director of the Marine Contracting Division. I joined Jane Fisher in August 2015 as Managing Director of JFD. I was then appointed as Managing Director of the Marine Contracting Division in June 2020. This is on the basis of my 25 years experience in marine and subsea contracting markets, combined with the experience in JFD focused on consolidating different businesses into a single brand. Marine Contracting is the division in Jane Fisher that is in charge of delivering marine projects and services across the offshore wind, oil and gas, marine civils, and salvage markets. One of the main purposes of the division is to lead the group energy transition from fossil-based to zero carbon. We are doing this by transferring our extensive experience and footprint in the offshore oil and gas into the offshore wind market. The division revenues are in excess of £100 million. We have 520 employees spread over 20 locations worldwide. Marine contracting includes several James Fisher existing brands, and the main difference from the past is the new operational model we have implemented. The previous operational model was mainly focused on each business operating on their own. This created confusion in the different markets, a scattered approach, and a siloed mentality, resulting in reduced competitiveness and higher cost. This to the extreme of having some of the group businesses competing for the same job. The new Marine Contracting Division changed this operational model by restructuring into two new brands focused on market verticals. Jane Fisher Renewables is a brand offering packaged solution for construction support and operation and maintenance to the offshore wind market. USPs for the brand are unexploded ordnance disposal, high voltage asset engineering, monitoring and management. High voltage meaning all components involved in the transfer of energy from the wind farm to shore, cables, connector, accessories, and whatever, whether subsea or topside. Blade maintenance and repair, and our extensive subsea experience transfer from the oil and gas. Our aspiration in offshore wind is to be a solid and global Tier 2 contractor, supporting the large main contractor for construction activities, and to consolidate our capabilities in monitoring and asset management as part of the operation and maintenance market. This will allow us to offer the overall wind farm field management directly to the main owners and operators. Jane Fisher Subtech is a global subsea and marine specialist created by consolidating JFMS, Subtech Group, and Continental. USP are our large experience in subsea oil and gas inspection, maintenance and repair, and light construction, the provision of niche capabilities in rapid response and salvage, and working in remote territories and difficult conditions. While restructuring and changing the operational model, we also reversed some of the previous investment decisions. As you know, in 2019, we acquired two dive support vessels, the Paladin and the Swordfish. Unfortunately, during the course of 2020, we experienced difficult market conditions. These required a change of approach, returning to an asset-light strategy and refocusing on delivery of high-end niche services. We therefore took the decision to sell one of our DSV, the Paladin, secure long-term frame agreement contracts for the second DSV, Swordfish, and establish partnerships with vessel owners and operators, facilitating the access to multiple vessels in exchange for market access. The change operational model will also allow us to strengthen our focus on operational and commercial excellence. This means stronger contract management, a centralized asset management, and a solid tendering support across the division. Implementing centralized function and processes will also optimize synergies, improving the sharing of best practices and reduce cost. This is especially in such areas as project management and engineering and supply chain management. Last but not least, standardizing our safety practices and establishing a strong lesson learned database. As introduced by Owen, meeting the portfolio test is a clear target, and the division is now fulfilling this requirement. On market size and growth, we are heavily supported by the offshore wind, with a forecast 21% CAGR between 2010 and 2030. The oil and gas market is steady with potential for high value upside. On competitive strength, we have hazardous and special niche capabilities, including high voltage, hooks to disposal, and our experience in difficult territories. The partnership with third parties to provide bundle solution, vessel and topside works, for example, and our extensive experience in emergency response and unplanned interventions. On sustained profitability, the new operational model with its synergies and the revised light asset profile will support the return to profitability and sustained returns. This plan is further reinforced by focusing into profitable niche segments and the smarter use of our existing capabilities at both divisional and group level. Let's now see where are our future growth opportunities. The main areas are strengthening and expanding our leadership in attractive niches, as well as exploiting the geographic expansion in offshore wind, exploiting the oil and gas recovery using our oil and gas experience and geographic footprint. Building on our experience and leadership in UXO, blade repair, and high voltage management is the basis to increase our presence in these attractive areas. We can achieve this by optimizing our current activities as well as adding further adjacent capabilities to reinforce our market position. For example, by combining our subsea and topside capabilities with asset monitoring, we can place ourselves as a credible supplier of wind farm overall asset management. As final target, we want to become our clients' preferred supplier, capable to deliver a scalable and credible offering and delivering these on a global basis. We are ideally placed for this, as most of our renewable clients in the North Sea are the ones leading the global offshore wind expansion, and they are already looking for companies capable to support them at different worldwide locations. As already anticipated, the offshore wind market is expected to grow at 21% CAGR up to 2030. Our existing North Sea presence is already supporting the growth for UK and Europe, and we have started expanding in the other two main markets, Asia-Pac and USA. In Asia-Pac, we have got an established base in Taiwan, as well as works ongoing in support of construction activities. The Taiwanese base is also being used to expand into the wider Asia-Pac markets. We have set up a business development presence in USA, and we are searching for senior roles, as well as discussing local partnership, especially with vessel owners and operators due to the Jones Act requirements. Moving to the oil and gas market, this is still forecasted for a recovery, albeit slower than other markets. We have seen good signs so far with increased vessel and equipment utilization, and we must be ready to take full advantage. The action is therefore to deploy locally our specialist high-margin capabilities, such as nearshore civil works, rapid response and salvage, specialist ROV and portable diving equipment. The areas we identified with the most sustained growth for these are Middle East, Africa, and Brazil. The results so far are quite encouraging, with contract wins of £64 million so far, and the sales pipeline with a potential value of £240 million. Compared with the same period in 2020, this is a 110% increase on contract wins. The main contributors to these are 24 million in the renewables, with the key wins being the wind farm cathode protection replacement for Ørsted, the UXO survey and disposal in the Fecamp fields for RTE, high voltage commissioning for Iberdrola on Saarbrück and Baltic Eagle fields. Then we have 40 million in oil and gas, with the key wins for the Swordfish that secured Subsea 7 and Saipem contract in Qatar and Saudi, the Paladin that secured West Africa project for Total and SBM, and long-term air diving services in Middle East and West Africa, and the vessel intervention project for Shell in the North Sea. In conclusion, as a main takeaways of this short presentation, the Marine Contracting Division is aimed to consolidate complementary James Fisher's businesses and provide world-class engineering and operational execution in the global energy transition markets. These, combined with the return to asset-light strategy, refocus on high-margin niches, and the strong geographic growth potential underpins our overall strategy going forward. Thank you very much for your attention. I will now leave you with Robin and new businesses.
Thank you, Gio. Good afternoon. I'm Robin Stopford. I look after corporate development. And as some of the sharper-eyed of you will have noticed earlier, I also run our digital and data services division. This afternoon, though, I'm just going to talk with my corporate development hat on. And this is a role I've done in the past, both for private equity-backed businesses, as well as publicly quoted companies, such as Spectrus, where I was most recently before here. I joined James Fisher in January last year with two prime objectives. Firstly, to work with Owen and the team on the strategy perspective, thinking through how do we reduce the complexity in the group that we see in order to unlock the undoubted potential that some of our capabilities can have. And secondly, from a corporate M&A perspective, make sure that the transactions that we do are inextricably linked to both the group and as well as the OpCo strategies. When I joined in January last year, we started the strategic review as you would expect, but of course, with the advent of COVID and the economic impact that resulted from it, we had to move at a much faster pace and move much more into implementation. We hope that by now you will have a sense of just how much we've done in the past 18 months and an emerging sense of the exciting opportunity that we have ahead. Over the next few minutes, I'll share with you both the processes that we're developing and some of the details on those opportunities that will give you an understanding of why we believe the vision that Owen shared earlier. If we think about from where we are in the strategic focus, this of course sits right at the heart of portfolio management. And as a result of what happened last year in COVID, and even while we are in the process of bringing our returns and our margins up to where you would expect, reinvigorating profitable top-line growth across the business is essential. The greatest opportunities, not surprisingly, given that we're talking to our customers, lie in the energy transition and geographic expansion. And longer term, for sure, we see opportunities from sustainability and technology, which will create a lot of upside over time. We're deploying some growth pipeline thinking to help prioritize, coordinate, and ultimately manage capital allocation for all of these opportunities. And achieving this is going to require a combination of organic investment, M&A, and then undoubtedly some partnering. You're now familiar with this representation of our portfolio. And the good news is that at least half of the businesses are well positioned to grow. This is a representation of who we are, has evolved materially in the last 18 months, and the reduction in complexity is well underway. We've completed 4 or 5 internal integrations just to get to this level of opportunity. And of course, we will continue to optimize the portfolio and think about the fix or exit businesses as well. But right now, as we start thinking about growth, the focus over the next few moments is going to be in developing how do we grow the businesses in the top right of this matrix to unlock their potential. As we reviewed the potential for above-market growth, there were some very consistent themes emerging. Not surprisingly, as we're heavily influenced by our customers. 2 of them are very near-term, almost core, if not sort of adjacent opportunities in energy transition and geographic expansion. And 2 of them longer term in sustainable resources and technology innovation. Just touching on some of the ones in the columns on our core businesses, you will probably remember that we announced not so long ago an investment in dual fuel shipping, first in the class in the world for some of our tankers. Elizabeth talked earlier about the ship-to-ship LNG transfer that we're working on. You will have seen from Owen's presentation that the geographic opportunity is writ large across the whole group. And some of the longer-term opportunities, such as waste management and remote or autonomous subsea operations, are a long way from where we are today. But I will be talking about offshore decommissioning, a piece of offshore wind, and then those 3 longer-term opportunities in oxygenation, flare gas reduction, and digitalization. And we've landed on these as a result of applying a growth pipeline to the significant number of ideas that came out through the strategic review. For those of you who know James Fisher, the fact that there's bubbling ideas through the group won't be a surprise. We have to make sure we put in place a disciplined process that identifies what the real potential is, bringing a lot of them centrally in, either because of the potential size or because it's pulling together multiple capabilities from OpCos, and prioritizing those down to the vital few that are going to have the biggest impact, and sometimes pushing others back if they're not quite there, and really focusing on the ones that are supporting our strategic direction. This, of course, creates a pipeline to understand the future CapEx, the M&A and partnerships that we need to do this. And inevitably, that provides the best possible information for the capital allocation that Duncan will then talk about in a few moments. The first project we're going to talk about is big bubble curtains. You'll have seen from the video, these are literally, as they sound, curtains of bubbles that go from big compressors through a network of pipework on the seabed to effectively put a curtain around the foundational, through the piling of wind farms, and sometimes also of UXO removal. The reason for doing this is, as you can imagine, the diameter of the wind turbine stems is about 10 meters. And smashing it into the ground with a great big hammer from a ship creates an enormous amount of noise. By putting these bubble curtains around it, you reduce that impact on marine life. Particularly, deafening dolphins is a phrase that's often used. This is mandated in most markets, interestingly, apart from the UK. And it's a part of the Scantech offshore business, so is an adjunct to our renewables work. And Scantech Offshore and their partners are, without a doubt, the world leader. They are the thought leaders in developing the technology, in developing new ways of doing this. And as the wind farms get bigger and the turbines get bigger and they're put in deeper, they have to think through exactly how to develop that expertise. And, for example, we're investing in cutting-edge electric compressors that are bigger and make better use of deck space, which, of course, in this market is critical. Today, the revenue is only about 6 million, but it's growing at 40%. And you saw from Gio's earlier presentation, the underlying market is growing at 20%. And of course, as turbines get bigger and they get deeper and our role gets wider and the services we offer get more, we expect this to continue to grow. So by 2025, 26, this could easily be £50 million plus. The second opportunity I want to talk about is decommissioning. Many of you will be familiar with the ongoing promise and under delivery of the decommissioning need. But that is starting to change. It's already expected that about 85 billion will be spent in the next decade in decommissioning around the world. And this is being driven by a number of factors. First of all, the natural ending of oil fields that have been extended and extended, but they're running out of life. Secondly, governments are really taking action. And thirdly, flexible, agile businesses like us are making sure that we reduce the time and reduce the cost for the decommissioning activities. And that's, of course, increasing adoption. We are, without a doubt, experts in well severance, complex cutting, and removal of subsea infrastructure. We've invested recently in the intellectual property of a business called Subsea Ingenuity, which gives us a new technology for collapsed wells, one of the harder part of well abandonment. And we're working on projects that include the Brent in the North Sea. We're working with Petronas in Malaysia, amongst others. Our revenue here is growing fast. It's about 200% over the last couple of years, going up to about £15 million. That's, again, not huge today, but we've bid on projects north of £60 million. Could this be up to £100 million by 2025, 26? That's certainly within the realms of possibility, especially given the range of services that we can continue to add to our wheelhouse. These last three are at an early stage. In all cases, there is a critical market need that we're trying to solve. We have market and/or customer access. And we also have some technology that our customers are going to value and that give us a real opportunity to make a significant difference in these markets. The first, the reduction of flare gas. Again, you will have seen from the video, you can see this from space. And if you were to take all of the gas that's flared off routinely around the world, it would be enough to power the African continent. And instead, it's burnt off as heat and carbon dioxide, which in a world where you care about global warming is not a good thing, and it's therefore not surprising that organizations such as the World Bank are sponsoring the Zero Routine Flaring by 2030 initiative. There are lots of businesses starting to work on this, and we believe that we can bring in some technology and deliver that in hard-to-reach parts of the world, not in huge oil fields where others can do it, but actually in the mid-sized ones where we can take the flare gas either to generate power or to compress it to enhance hydrocarbon recovery or to convert it to liquid fuels. The range of opportunities are significant. The second is on digital twins. Again, this is a market that people have talked about in the past, but in the last 15 months, when people haven't been able to access their remote assets, suddenly they realize just how important having a digital twin that can predict future performance will be. We have some technology within our AIS business that is really a game changer here, that allows setting up a good understanding of what exists today. We're partnering where appropriate to build out a more complete solution, and already we're strengthening the order book here. It stands at about 4 times where it was this time last year. It's less than 10 million, but we expect to see a lot of growth coming out of this space. The third of the projects is oxygenation for aquaculture. Many of you will have seen Seaspiracy, and therefore see that there is, of course, a huge environmental challenge, not just from fishing, but also aquaculture, and making sure that aquaculture is done in a sustainable way. We're partnering with an organization that will, and where the combination of our compressor capability and their technology will reduce the amount of oxygen that's required and make sure that the fish get oxygen more efficiently, reducing the cost of oxygen, saving and allowing fish ultimately to grow faster. We believe this will reduce things like lice, minimize waste. Our focus is on the Norwegian salmon market. Not surprisingly, as the business in question is our Scantec RS business, which is based in Norway. Already we're seeing the first sales earlier this year on a recurring revenue basis. We have a strong pipeline of future customers. And without a doubt, this is I would say, an adjacent business rather than core to what we do, but it may well open up a significant long-term opportunity for us. It's the combination of all of these projects and others from across the group that creates the opportunity that we see here. As we sit in the middle of the energy transition, it's entirely conceivable that our remediation activities, renewables business, redefine the future of James Fisher. So in summary, we're reinvigorating profitable top-line growth across the business. We see a lot of customer-driven opportunities in markets that are either core or close adjacent to where we operate today. We're applying growth pipeline thinking to make sure we curate this well. And that supports our belief that there's a significant potential to transform the group. With that, let me hand over to Duncan, who will describe our approach to capital allocation. Duncan.
Thanks, Robin. Good afternoon, everyone, and thanks for taking the time to join us today. As a bit of background on me, I joined James Fisher 8 weeks ago to the day. I spent my last 14 years working in healthcare at a company called BTG, and my last 2 years at that group as CFO. For those that don't know BTG, although a different industry, there are a number of parallels between its business model and that of James Fisher. It used cash flows from a legacy business to move up the value chain and ultimately own, make, and sell its own products in niche markets. It had a relentless focus on customer intimacy. That business was sold to Boston Scientific in 2019. So after BTG, why James Fisher? Well, I was offered a couple of other positions before accepting this one, but it was clear to me that James Fisher ticked all of my boxes. A strong board, an open culture, a broad role, and a technology-led business with significant growth opportunities. And that last point is really important. The opportunity to work at the heart of the energy transition is really exciting, and we're very well placed to capitalize on that. So 8 weeks in, has it lived up to my expectations? Well, the short answer is yes. The people I've met are proud of their company. They're focused, they're certainly resilient, and they could not have been more welcoming. When it comes to governance, systems, controls, all the key frameworks you'd expect to find are in place, and there's a definite willingness to continue to improve. But it's not all sweetness and light. There's no hiding from the fact that COVID has disrupted the markets that we operate in. It's clear that everyone's remained focused on their core customer offering. They've made internal changes to improve efficiency, and they're ready for the markets to open up. So let's take a look at capital allocation. It's no surprise to see it as a critical process in our strategy. And having spent a little bit of time now getting to know the group, where do I see its priorities? Well, our first priority is clearly returning to sustainable, profitable growth. And our targets are to consistently deliver more than 10% operating profit and more than 15% return on capital. This will help drive priority 2, which is reducing the group's leverage, where we clearly recognise that it's higher than our sustainable target. In addition to driving profitability, we're also taking direct actions outside of normal trading activities that will generate additional cash. Reinstating a progressive, sustainable dividend will be possible once we've reduced leverage, and the board remains committed to paying dividends at the right time. Lastly, you've already heard that we're in a position to use capital allocation to directly improve our impact on the environment. Let me dig a little deeper. Firstly, a simple overview of our financial framework. Our operating cash flows are targeted at sustainably delivering margins above 10% and a return on capital in excess of 15%. These metrics are the focus of our investment reviews, whether that be capital expenditure or M&A. And we deploy that capital to a combination of organic and inorganic growth opportunities and to shareholder returns. That's fairly high level, so let's take a look at a few more specifics. Delivering on our priorities for capital allocation is enabled by focusing on where we get our capital from, on the left-hand side of this screen, and how we deploy it, on the right. Our key sources of capital are operating cash flows from the business, proceeds from disposals, and the use of debt and equity financing. In terms of operating cash flows, we're seeing some positive signs of business momentum building in our order books, and Gio's described the impact in his division so far this year. We're continuing to maintain a focus on working capital, and I believe that some of the work we're doing on customer and supplier relationships will assist us here. The team's focused on collecting debts as they fall due and being a responsible customer ourselves. Recognizing the current leverage of the group, we have active programs looking at disposing of non-core businesses and monetizing some of our fixed assets. As you've already heard today, we've completed 2 small disposals this year, and the Paladin dive support vessel is up for sale. I expect to be able to report more progress in the coming months. The group's maintained good access to capital throughout the pandemic and has maintained strong relations with its banking group. We're confident that we have access to adequate capital in the debt markets to drive the recovery of the business and start back on the growth path. We're targeting a sustainable leverage ratio of between 1 and 2 times, which we believe will be sufficient to fund expansion plans and will leave some flexibility for M&A at the right time. And where will we deploy our capital? Well, within the business, it's a question of balancing organic growth and M&A opportunities. And as I've said, the same operating profit and return on capital targets apply to each, although we do recognise that a new venture, whether organic or inorganic in nature, may need time to reach these levels. Turning to shareholder returns, our intention is to reinstitute a sustainable dividend policy at the right time. So why is James Fisher such an interesting investment proposition? Well, let me remind you of the very real opportunity that we have over the coming years. Not wishing to ignore our specialist technical division, and you've heard from Richard about some of the exciting opportunities in JFD, I just want to take a moment to focus on how we see the energy transition shaping our business over the future years. We're responsible owners of our oil and gas businesses, and forgive the colloquialism, but let's call that old energy. As you've heard from Liz today, we're continuing to fund growth opportunities in that sector, and we'll continue to make improvements to our products and services to reduce the environmental impact that our businesses may have. Surplus funds from these old energy sources are available to fund growth elsewhere. We're actively involved in environmental remediation of old energy sources with existing capabilities and with existing assets. And as you've heard from Gio in particular, we're enabling the next generation of energy, particularly with our service offering to offshore wind farms. Finally, as you heard from Robin, we have a number of new businesses, each of which could have a positive environmental or sustainability impact. So to wrap up, it's an exciting time to have joined the group. It's not without its challenges, but we're focused through the responsible deployment of capital on building sustainable, profitable growth, reducing our leverage, reinstating a dividend, and improving our environmental impact. And with that, I'll hand you back to Owen. Thank you.
Thank you, Duncan. And thank you all for your time. We're almost at the end of the program, but let me just take a moment more before we open up to Q&A. Our strategy for sustainable, profitable growth is underway. We've embarked on a purpose-led and values-driven journey. As an essential part of that, we're bringing all of our stakeholders into the heart of the company, and we look forward to engaging with many of yourselves to that end. We've already and will continue to upgrade our talented teams. We're driving better governance with a division structure, pushing decisions to where they need to be made. And we're deploying lean principles to deliver operational excellence and to underpin growth and margin expansion. We're embedding a capital allocation process and risk management culture, and we're focusing the portfolio on niche segments with a view to fixing or exiting underperforming assets and businesses. And finally, we're accelerating investments that support our role in the responsible energy transition. As a reminder of our 3 Rs roadmap, we've defined our purpose and valued behaviors, and we're focusing on the critical and urgent. We're fixing the portfolio, accelerating operational performance, and investing in the energy transition. And then we will deliver top quartile, sustainable, profitable growth. Thank you all very much. We're going to take some questions now.
Great, we're back live. And I know Duncan is something of a capital allocation nut, but apologies for the fact that he went through it twice. It was so good, we thought it was worth running twice. But let's come back to Darren's question earlier. Giovanni, you have had a good opportunity to prepare for this, so we're expecting a good answer. How big's the opportunity for James Fisher with floating wind farms?
Thank you, Angus. Floating wind farm is a very exciting opportunity for James Fisher Renewables because it is a very fast growing market. Consider that 1 year ago, this technology was still considered as not feasible. And here we are, 1 year afterwards, already working with the client on the first test trial. And not to forget that the design of a floating wind farm is so similar to similar installation in the oil and gas, whereby we got plenty of experience in construction support and inspection, maintenance, and repair. So in a nutshell, can't wait to get going with this opportunity.
Good.
Thank you, Angus.
I will watch and look forward to that with interest. Now, we had just a few questions that we're going to open up with that came in just as we were closing the previous section. So we're going to start with one from Argus Global for Owen. Owen, what's the most significant upside risk you see in the next 12 months?
Thanks, Angus. Well, I think, first of all, renewables, offshore wind included, and floating offshore wind, maybe most particularly, this market may very well take off. And we're poised to support the growth, both in our home markets of the UK and the near continent, but also in Asia and the US. That would be one. But also oil and gas decommissioning, where, as Robin explained, we're on quite a trajectory of growth at the moment. And considering how much we have tendered, 60, 70 million pounds over the past half year, that's a business that certainly has, if you would phrase it like that, upside risk to it.
Coming back, Owen, I think the next couple are for you as well. So we're going to come to an Andrew Douglas question. How well do you score on ESG, on the E element at present, and what's the objective?
Understood. Andy, thank you. We contribute to the CDP program, where our environmental activities are measured in a fairly objective way. We went through the first formal assessment by CDP in 2020 and came out with a C+ rating. It's not an A+, it's a C+, and that's the objective, is to improve year on year, and we'll go to C-, to go to C+, go to C, go to B, go to A over the next few years, one would anticipate. In addition to that, Morgan Stanley have scored our environmental track record as a B. Those are two fairly objective measures. Beyond that, I think we measure ourselves in terms of the impact we have on the environment through the work that we actually do. And our customers tell us that we are the most trusted and the most trustworthy when it comes to environmental consciousness.
Good stuff. A question from James Tetley, again, back to you, Owen. You opened the presentation with the importance of aligning the whole firm on a shared strategy and purpose. Where are you in that particular aim, and how are you going about tackling it?
Very good. Thanks, James. We're a year in. We've crafted, re-articulated our purpose statement. We've reimagined our valued behaviours, and we've taken those out to the entire organisation of James Fisher in a series of, it felt like months-long roadshows. The response has been astonishing. And perhaps it shouldn't be surprising, because our conviction now, having spoken to our entire organisation, is that in fact James Fisher people were waiting for the group to articulate what it is that binds us together as an organisation. But this is a cultural rejuvenation programme. It's not something that is achieved as a project might be. It has no end to it, but I would say that we're off to a good start.
Very good. Now, the next name I conjure with, having had more than a decade of questions from John Lawson in his previous life, a number of very interesting questions. So, Owen, we'll go through them. I think the first one will be for you, and then Duncan, I'm going to ask you about reintroducing progressive sustainable dividend. But Owen, going forward, what proportion of group revenues would you like to have from annual recurring income streams compared to project work, where the margin might be higher, but they're less predictable?
Very good. Thanks, John, for the questions. Our current business is made up of about a third each for projects, products, and services. And within those services, there's quite a bolus of recurring revenue streams. We would anticipate growing that strongly. The margins can be more attractive there. And as we invest in businesses, as Robin described to us, for example, in aquaculture or in flare gas reduction, both of which are likely to have recurring revenue streams to them, we would anticipate that that component of service, the recurring component of service, will continue to grow as a component of the overall revenues for James Fisher.
Very good. Now, Duncan, today's RNS refers to the reintroducing of a progressive and sustainable dividend, as we say, the right time. Explain what criteria and metrics have to be met for this to occur.
Great. Thanks for the question, John. As I ran through the financial priorities, our first priority is to get back to sustainable operating margins and return on capital. You've seen already that we're focused on generating cash outside of trading activities to reduce our leverage. And really, it's that reduction in leverage that will trigger the board reintroducing dividends at the right time. And that's a discussion that will remain live around the boardroom over the coming months.
Back to you, Owen. You seem to have taken over from Liz as the main answerer this time. The Subtech Paladin is in the process of being sold to CMEC per its press release of 27th June. Why was there no mention of this in today's RNS?
Well, very good. We announced more than a month ago that we were going to sell the Paladin. We've been in discussions, and we continue in discussions with buyers. And once the process closes, we'll make an announcement.
Thank you. And this was the type of question that Mr. Lawson used to ask me that terrified me, because I very rarely knew the answer. So good luck with this one, Owen. When could liquid hydrogen carriage by sea become a reality? And Kawasaki is exploring this market. Are we talking 10 years or less, or might it never be at all?
I don't know is the answer to that. As Liz said, we are closely monitoring adjacent transportation markets like liquid hydrogen. To my recollection, Kawasaki have built the first liquid hydrogen transportation ship in the world. It's not in operation yet. I think it's supposed to be commercial in the next 5 or 6 years. And I would anticipate that if that's successful, that market then will find other entrants. And we ourselves, as Liz suggested and highlighted, we have the capability to supplement what we do in crude oil and in LNG to also enter the liquid hydrogen market, should it develop in the way that Kawasaki and others are suggesting.
Right, Owen, back to you again. I'm going to ask you this in bits because it's a long question. which we'll try and kick through and get on to others after it. So the first piece, I'm trying to understand if James Fisher is an equipment and specialist skill rental business. Is it discrete projects, or is it a captive customer recurrent revenue contract operation?
That's a complex question, a compound question all its own. The answer is yes, depending on the division. We operate through multiple operating models. If you take tank ships, purely service. If you take specialist technical, product, service, projects, and the other two, a mixture of those. We actually like having exposure to different operating models because in the three markets where we operate, marine, energy, and defense, our customers demand that of suppliers. And we're happy to follow our customers' lead in regard to what operating model they would prefer, whether a direct product sale or a product sale and after-sale service. We can do both.
Good. Now, part two, can you explain how business is won? Who runs the marketing in the books business? Explain how pricing is determined and discuss whether a retainer model would ever work.
Well, our decentralized model is based on, as I mentioned earlier, autonomous operating companies. They are the folks who have the direct contact with customers. And so they tender, they win, and they deliver. Then our divisions are made up of portfolios of those operating companies, and there's a certain amount of coordination, player, coach, activity within the boundaries of a given division to try and optimize the work that we're doing for a given market or a given set of customers. That's the first part of the question. What was the second part of the question?
About pricing.
Yeah, pricing is determined, again, entirely in the operating company and in the division. And it's not something that we at Group take a view on. We have a view that pricing as a discipline is something that can be learned, and we regard it as one of the key disciplines to help improve profitability, particularly focusing on gross margin. So we have a view that there are things like pricing that we would like to see extrapolated across the organization from best practice to other operating companies, but those activities start and finish within the boundaries of the operating companies and the divisions.
And within that pricing model, do you think there's any opportunity for a retainer model?
We haven't seen it. Our rental business is one where we rent out fleets of kit for years on end in some instances. And we don't necessarily depend on retainers where we would come in when a service is required. And I'm not sure that we see it in the particular markets or with the particular customers that we operate with.
Now, in terms of question 19, I'm going to throw this to you, Duncan, and then we're going to come back to the raised hand of Alex Patterson. How much opportunity is there with regards to reducing working capital? What's the right working capital to sales ratio for the group, and how do you get there?
Yeah, great question. So if you look back at the group's conversion rate from operating profit to operating cash over the last maybe 5 years, I think you'll see there's sort of an underlying very, very high proportion. So somewhere in the 90 to 100% operating cash conversion there. What you also see, which is why the answer isn't perfect, I'm afraid, Andy, is that the project businesses do mean that their working capital flows can be quite lumpy over a reporting period. And you saw in the RNS today that, you know, as we sit at the half year, we're expecting a working capital outflow this first half, mainly due to, you know, some big milestones that are invoiceable in half two and not in half one. So an underlying very positive cash conversion rate with some lumps and bumps along the way is the best answer I have, Andy.
Good. And then the final question, Duncan, any disposals included in that table of numbers?
No, we're not. No, there are no disposals.
So that's the business as is.
That's as is.
Well done. Thank you. Right. Going back to, it's a great phrase, top quartile. I know when you used it on the last slide. Can you define what that actually means in terms of growth to help Andrew Douglas?
Andy, thank you. It's not easily defined, I'll grant you that, but we track a range of co-participants in our markets, recognizing we're in 3 separate markets. and we can identify what is the aggregate growth rate for each of the markets and then for the overall. And we're saying that relative to those peers, we believe that we can get into the top quartile of growth and sustainably.
Good. Another one from Andy. Offshore wind in the US and Taiwan. I'm going to let Giovanni, supported by Owen, answer this. How are you getting on in these new markets? Has it been as easy as expected to get into the US market in particular?
Thank you, Angus. Well, the US market is just flourishing at the moment. And we already, I mean, one thing to consider is most of the clients in the US market are our European clients. So we know them and we are moving with them. We already target some of the opportunities there. And we already established a presence, as I've outlined in my presentation. We got a senior BD person in place, and we are recruiting for a vice president or president type role, and we are starting to expand. We have already in place a discussion for partnership for vessel operators. So I think that we are well placed to target this market when we believe it will start flying, that is from next year onwards. And you want also Taiwan, or because there was a note on Taiwan.
Let's hear about Taiwan.
Yes, in Taiwan we already have an established presence with an office. We got the general manager there. We got already some construction support work ongoing, and we have been there for the past 2 years with a plan to strengthen our presence and also use Taiwan as a base to expand in the Asia-Pac market.
Very good. Seeing you're on such a roll, Ignacio is asking, could operating an asset-light business model in the renewables vertical be a disadvantage versus other vertically integrated players, Giovanni?
Yeah, probably I wasn't clear enough in my presentation. So we are going to an asset-light ownership, not an asset-light model. So we are replacing ownership with a partnership, and we are tackling the construction support, the O&M type project with the same muscle, with the same asset our competitor has got. It's just a different model, reducing ownership and using partnership, and that we have seen as a future model that will be a winning one.
Good, thank you. And Owen, you can decide whether you take this question or you give it to Giovanni. It's from Tom Rands. Regarding the decommissioning opportunity, please remind us of your new unique IP and customer cost-saving proposition. And what's the recent win rate that we could apply to the 60 million plus tendering pipeline?
Thanks, Tom. Our IP is based on specialized cutting and lifting, and we have a range of technologies supplemented by a recent acquisition of a UK startup called Subsea Ingenuity, where they're specialists in coming in after the well is capped. They put in what's called an environmental cap. Combining that with our specialist cutting and lifting really advantages us compared to any single provider. And the benefits we bring to our customers is that we can put all our kit on one boat. And that vessel then can complete a significant part of the decommissioning of a given well or a selection of wells without having to bring additional vessels, which can be very expensive to deploy on a day rate.
So just building on that, a question from Miguel Lopez. What's James Fisher's exposure to MRO versus new build in renewables? Why do you answer that? And I'll give you part two.
We actually like doing both. We like being involved in the initial planning as well as construction, and then thereafter getting contracts to manage the operations and maintenance of the assets or the entire wind farms at times. I think as part of our new strategy to focus on the niches where we add really differentiated, defensible value to our customers, we're going to be more selective about which projects we take on board. We are undisputed number one in certain areas. For example, in the high voltage cable side, or in unexploded ordnance, or in blade repair. In the other areas, there are benefits to combining activities, combining service types in the interest of providing value to the customer. But we're going to be careful that we don't take on projects simply because they seem big. We're going to be focused on sustainable, profitable growth, perhaps a little bit more than we had been in the past.
And Owen, as you look at it, is not being present in the construction part of the renewables a disadvantage to gain the MRO service contract? That's the second part of Miguel's question.
I think it depends very much on what the O&M, the operations and maintenance service, is about. If it is O&M of the high voltage cables and high voltage assets, I think there could be a case made that it's important to be involved in the initial planning, engineering and construction. If it's more on the balance of plant or mechanical O&M, we don't think there's any real connection.
Good. Slightly different subject, but still with you, Owen. Is there a target for R&D? This is Tim Freeborn asking either in absolute terms or as a percentage of revenue.
Tim, thanks very much. The answer is no. We don't have a group-wide target, but we do have targets within the individual operating companies and in some divisions. My own conviction is that as we focus more on profitable growth, sustainable profitable growth, improving gross margin, generating operating leverage, and thereby creating more operating profit, we should be plowing more of that into innovation. So whilst we don't have a group target, I would anticipate that the targets we have within the relevant individual operating companies will go up over time.
Good. Back to Argos Global, and this is the final question that we've got at the moment. We've still got 10 minutes, so if people have other questions, please either raise a hand or type them in. Can you quantify the assets employed in the rental businesses is part A?
Yeah,
and then
absolutely.
Part B is, would you think about moving these off your balance sheet?
On the second part, I'll defer to Duncan. In regard to what the assets are, there's a range. These are air compressors. These are cranes of various types, winches of various types. Those are across a number, 2 or 3 of our operating companies.
Yeah, and just to pick up on financing, we have a mix across our business of owned and financed assets. I think the accounting these days tends to put everything on the balance sheet. But, you know, we look at each of the significant CapEx investments on its own merits.
Well, it's a bit like ringing the last orders bell in a pub. When you do that, you have lots of people. So we've got another couple of questions here from Alex Patterson. Can you say what 2 businesses were sold and how much for? And then I'm going to give you a brief part B.
Very good. Alex, thanks for asking. But in fact, we can talk about them. There's one in Germany. There's one that is a quick release hook business. That was a subset, a business line of one of our operating companies. Those are the 2 that we've sold so far.
And have you not announced the sale of the Paladin as you think you could sell it for more than 17.3 million? And I would take from your first answer, these are small disposals that we've done.
Yeah, the first 2 disposals indeed were not very large parts of the portfolio, but they were, by definition, at least for us, non-core and non-performing. As I mentioned earlier on the Paladin, we are intent on selling that vessel. We've had a lot of interest from prospective buyers. We've been in discussion with buyers, and once it closes, we'll make an announcement. I wouldn't want to be drawn on value at this stage.
I think that's us. It's 25 minutes past. We're on target for our 4:30 finish, so everybody's got time to get to the right place for the kickoff. Owen, do you want to say a couple of things just to finish this off?
Thank you, Angus, very much. Thank you, first of all, to my colleagues here. There are, for us, many things that have to be done to put a capital markets event together. We hope that you got value out of what we presented today. It is a new strategy aimed at creating a pathway to sustainable, profitable growth. We'd anticipate, as Angus suggested earlier, finding an opportunity over the next months, quarters, years, to meet with each of you personally to get your direct feedback on what you have heard so that we can improve for the next time. But for today, we'd like very much to thank everybody who took time to join us for this capital markets event and wish you a very good afternoon and all the best to those of you interested in the football.